So the title of my presentation today is Was the US Great Depression a Credit Boom Gone Wrong? I'd like to emphasize that this isn't an original research paper. I was asked to sort of give an opinionated piece on the literature on the subject at the moment. And as I think that there's been a lot of interest that has arisen about the Great Depression itself and whether it was a credit boom gone wrong since the 2008 crisis, I thought this was really a great opportunity to sort of review the literature and try to tell you a little bit about what I think about this literature, especially in terms of my own research. As you can imagine, there's lots of different angles through which you can approach this question. And I've picked one particular angle, which I thought was perhaps particularly relevant to the current literature at the moment, which is this one. So, can monetary policy keep credit under control? Okay. There's been a lot of debate recently about the effectiveness of monetary policy in terms of trying to keep credit under control. Especially since the 2000s in the US and in Europe, where we've seen that sort of focusing on inflation for a central bank might not be sufficient enough to understand what's going on with credit and to control credit. And also inflation itself might not reflect, might not be a good measure of credit events in the economy. And one of the ideas that is really sort of buzzing at the moment in financial circles, I hear especially at the ECB, I was in Frankfurt a few weeks ago, is the idea that if monetary policy is insufficient to control credit, then we need to use other tools, such as macroprudential tools, right? And this idea has been more or less buttressed by the work of Schulrich and Taylor in 2012, who have shown that since 1945, roughly, there's been a decoupling of money from credit. So whereas beforehand, one might say that credit and money grew in tandem, from 1945 onwards, you see a sort of decoupling where credit sort of has a life of its own and seem to increase more rapidly than money. And so what I want to ask here is, can we learn anything? Is there anything that we can learn about this question from the US Great Depression? So first of all, I should be very clear that the idea that a credit boom, was the cause of the Great Depression and made everything worse is not actually accepted by many economic historians. So to start with, Friedman and Schwartz, famous authors of the 1963 book, A Monetary History of the United States, showed that there were many, many bank failures, in fact about 7,000 bank failures in the Great Depression in the US, but that most of these bank failures were sort of the victims, right, of an exogenous liquidity shock over which they had no control. And so the banks could not be seen in any way as responsible for what happened, right? They were not responsible for any credit boom that they initiated. Now, of course, on the other side of this debate, there's been other people starting, right after the Great Depression, such as Galbraith, Peter Galbraith, Charles Kindleberger, and others, who have shown that actually credit booms do have some explanatory power in terms especially of the bank failures that happened from 1930 onwards. This view was sort of fairly informally put. And then there is an important paper that came out in 2003 by Barry Eichengreen and Chris Michener, who sort of formalized the idea, although they looked at 20 countries, right? They didn't just look at the US, but they said that the intensity of the credit boom in the 20s was very much correlated with the intensity of the downturn in the 1930s in most of these countries. There's also been some of my work published in 2016, 2017, showing that Chicago bank failures, Chicago was the city that had the highest urban bank failure rate in all of the US in the 1930s, were very much dealt with mortgages and had a great increase in credit in the 1920s, and that had made them vulnerable to further shocks that occurred in the 1930s. And so there's other works by, for example, Eugene here, Calamirez and Mason, sort of showing that the banks were vulnerable, right? They were vulnerable ex ante. There were signs, there were ways in which you could see that the banks that ended up failing in the 30s were different from the banks that ended up surviving ex ante. You could see some signs, some ways in which they were different well before the crisis started, right? So it's a sort of literature emphasizing the vulnerability side of things. Now, what about the role of monetary policy? Well, monetary policy, as you can imagine, is also very much a point of contention. Although I would say that almost all authors agree that definitely Federal Reserve inaction in the 1930s made things worse, right? That's something that has been put forward first by Friedman and Schwartz, but that has been sort of followed by Richardson and Troost and Carlson here, Michener and Richardson, and Richardson, who have just published a paper very recently. But they disagree about monetary policy as a cause of troubles. So there's a lot of disagreement about the idea that monetary policy might have been a cause of bank failures in the Great Depression, might have been a cause even of the boom, right? So just to start with, Friedman and Schwartz here, Friedman and Schwartz in 1963 emphasized that monetary policy in the 1920s, if anything, was quite tight, especially in the late 1920s. And so because monetary policy was so tight, that actually had a negative impact on the economy, which potentially, eventually, had an impact on the viability of banks, right? But so the emphasis is on tight monetary policy. And then there are other authors, such as Hayek and Lionel Robbins in 1934, or Rothbard, who have said that, in fact, the Fed was conducting too loose monetary policy. Right? So these people have been emphasizing the boom, the credit boom in the 1920s, and saying that it was actually very much the fault of the monetary authorities who were conducting loose monetary policy. And then the other papers by Eichengreen and Michener and myself and other people in the room have actually shown, well, that they're actually pretty silent on the role of monetary policy during that time. So they show that banks were vulnerable ex ante, but they don't really say much about the role of monetary policy, including myself in my own papers. So in this paper, I tried to do something a little different, where I tried to just ask, what are the facts about monetary policy and this credit boom? Okay. And actually, I just look at data that's, from the all bank statistics and monetary statistics, and I look at the very broad aggregates. And I show two things, right? One of the first things that I show is that credit and money grew in tandem in the early 1920s, right? From about 1920 to 1926 onwards, you see quite a great growth in money, in the money supply, and quite a great growth in credit as well. But afterwards, something seems to change. In 1927, 1928, 29, it seems that credit starts to grow faster than money. Okay, so we have a sort of decoupling of money from credit that some have seen for the post-1945 period, but which we already seem to see in the 1920s. So, but what can that say about the role of the Fed at the moment? Well, during that time when credit was growing faster than money, well, the Fed was actually conducting first loose monetary policy for a while, but then tight monetary policy. And despite this tight monetary policy, it looks like credit was growing anyway, faster than the money supply. So the Fed was sort of unable to quell the credit boom. And this, I would say, does sort of buttress the idea that we need more macroprudential tools to deal with these sorts of credit issues. So let's just start with this puzzle, okay? You've all heard, it's sort of in popular history that there was a credit boom after all in the 1920s. But then actually, so you might think, inflation was quite high in the 20s as well. Not at all. Inflation in the 1920s in the US was very stable throughout the 1920s and up to about 1929-30. And if anything, from 1927 onwards, it starts falling a little bit. Okay, these three lines are the CPI, different CPI and wholesale price index indices. Okay, what about money? So if we look at the money supply, so this is data from Friedman and Schwartz themselves, but also the Board of Governors of the Federal Reserve System. So these are just really broad monetary aggregates, which we can call M2 and M4. They don't really correspond to today's M2 and M4. M2 is just currency in circulation plus deposits, time and demand deposits at commercial banks. M4 is the same thing plus deposits at savings and mutual savings banks. And what we see in terms of the money supply here is that, there seems to be quite a large growth from 1922 to 1926 onwards, but then it sort of, slows down a little bit from 1927, 28, and 29, right? So the money supply sort of may partly explain the lack of inflation going on during that time. Now, if we look at credit, well, credit actually does grow quite a bit faster than the money supply in the second phase of the boom, right? So, for example, let's compare like for like, right? So if we compare M2, which only concerns commercial banks, with commercial bank loans here in black, we can see that in 1929, there is a faster growth of loans at commercial banks than the money supply concerning commercial banks. And then if we look at the M4, which includes deposits at mutual and savings banks, well, we can see that there is the increase in loans at these banks is actually much faster than the money supply for these banks, if I may express myself this way. So really, we see two phases of the boom, right? There's the first phase when money was plentiful, right? The US had just come out of the World War I. It was a world creditor. A lot of gold was flowing in, and money grew and credit grew around the same time. But then in phase two, what happens from 1927 to 1929, then we see that credit starts to go faster than the money supply, which is sort of tapering off a little bit. And the Fed loosens policy in 1927, but it tightens it in 1928, and that seems to have no significant effect on credit. So let's just look at Fed discount rates here. We can see that in 1927 here, there is the small decrease from 4% to 3.5%. So that's sort of the loosening up of policy, but then in 1928, it starts going back upwards again to about 6%, and then further up to, 5%, and then further up to 6% in 1929. So who were the lenders? Well, in 1929, total corporate and household debt amounted to about $161 billion. And 2/3 of that came from non-commercial bank sources. So these are the ones that I just talked about, for example, the mutual savings banks and the building and loans associations. But there were also investment trust companies, insurance companies, and sales finance companies. Also, 1/3 of that, which is not negligible, 1/3 of that debt was coming from commercial banks, right, about $50 billion. And all of these institutions had grown tremendously in terms of credit in the 1920s. What were they lending? Well, the mutual savings banks and BNLs, Building and Loans Associations, the ancestors of the Savings and Loans Associations, mainly made mortgages. Commercial banks lent in various ways. They grew in various ways. So the state banks, the state chartered banks, increased mainly their mortgages. I'll show you a graph in a moment. National banks, who were under different regulations, they also grew quite massively, but they grew in other loans, pool loans, and other stocks and bonds. So this is residential mortgage debt from the time, and we can see the great increase in residential mortgage debt by type of institution throughout the 1920s. This is state bank assets in the 20s, and we can see that the greatest increase is indeed in real estate loans here. There's also an increase in government bonds and in other stocks and bonds here. For national bank assets, we see that the increase in real estate loans is much smaller, but there is a great increase in government bonds, other stocks and bonds, collateral loans, which are core loans, and other loans. So then we might ask, why did commercial bank credit grow faster than M2, right? And this, I would say, is still very much an open question. I try to answer it a little bit in the paper, but I probably don't do it as well as I would like, and I think it's something that people should do more research on. Banks at the time still funded themselves mainly via deposits, right? So you can't say that they started funding themselves via non-bank sources, such as money market funds. So that's not the case. And also, quite interestingly, although again, this is very aggregate data, right? So it's not an average of individual balance sheet data, so there might be problems with it. There seems to be no significant increase in leverage in the 20s. However, I'd like to add here that in my work on Chicago banks, where I do look at individual state bank balance sheets, I can also see that there is no increase in leverage in the 20s, right? So that's sort of strange. What we see, however, is a decrease in total cash over 1927, 1929. So let me just show you this graph. So this is total assets here in light gray, which grow in the 20s. This is total capital here, and we can see that there is a bit of an increase in leverage here, but then it sort of catches up with total assets. However, cash here, which is in black here, does seem to sort of decrease from 28 to 29. Could that explain, the difference between M2 and credit? Perhaps, okay, but I'll sort of leave it there for the moment. So the conclusion on this seems to be perhaps that capital grew, deposits grew, but loans grew more, right, while cash stabilized or fell. So what this means is that overall, for sure, right, this great increase in credit made banks much more vulnerable. Okay, banks became, through this increase in credit, vulnerable to any shock, really. They would be vulnerable to exogenous asset price shocks. They would be vulnerable to exogenous liquidity shocks. And even if these shocks were, exogenous, and a lot of work still needs to be made on trying to find out whether they were exogenous or not. But even if we accept that these shocks were exogenous, for sure, you can't say that the banks were just simply the victims of these panics, right? They were vulnerable ex ante. So an example of this, as I mentioned in the introduction, would be my work on Chicago banks, but also Calomiris and Mason's work. So just to sort of illustrate, this is one of the graphs from my work on Chicago state banks. And we can see here, so this is the amount of mortgages to total assets classified by the time at which banks failed. So, you have 1931 failures here in red, and then in green you have 32 failures. And then in yellow here, you have 1923 failures, and the survivors are in blue. And we can see that over the 1920s, the banks that failed the earlier had the highest amount of mortgages, and then those that failed later had a lower amount, et cetera, et cetera. Okay, so it definitely made them vulnerable to the liquidity shock when it came. So then you might ask, to what extent were the shocks actually endogenous to bank credit? Okay, this is, I think, a question that you're all interested in. And it's very difficult to answer that question. And I think a lot more work needs to be done in that area. Especially as we know that at the time, there was no general inflation, as I just pointed out, right? There was no general inflation in the 20s. But profits increased tremendously, so did real estate values, and so did stock market values. Okay, so you might be able to say that perhaps there was some asset price inflation that was going on. And this was an observation that was made by Domain and Keynes in 1934, right? He's like, because a lot of people are saying, but why was there no inflation? And he said, well, it was asset price inflation that was there. He didn't put it that way exactly, but he pointed out these rises in different types of assets. So is credit to blame for this asset price inflation? I should mention that in the paper, I talk about two aspects of these asset price inflation. I talk about the real estate side, And I would say that on the real estate side, the data is unfortunately, is very preliminary. And I think a lot more work needs to be done on real estate. So, and also for the sake of brevity, I'm going to focus on the stock market. But if you want to look at what I say on real estate, you should just read the section in the paper. So I'm going to focus on the stock market here. So the question is, was the stock market bubble sort of endogenous to credit, okay, and to bank credit in particular? And of course, was the crash then endogenous to credit? And I'm only going to show you some sort of preliminary output on this. So first of all, just to get this straight, was the 1929 stock market bubble a bubble? Was it really a bubble? And I would say that on that, the literature is fairly clear that it was indeed a bubble. So this has been shown in brilliant work by Eugene here, and Rappaport and White as well, who have shown that it was indeed a bubble. You see in particular, for example, you can see on the graph that dividends didn't grow by as much as equity prices in the late 1920s. And another thing that we know for sure, and that has been emphasized by Peter Galbraith, is the importance of brokers' loans. So brokers' loans basically allowed people to buy stocks on margin. And if we look, this is another graph from Eugene, this really striking graph, right, where we see these are stock market prices going up like that in 1928-29. And then we see that brokers' loans have almost, grow at almost exactly the same pace. It's quite striking. But were banks responsible for the increase? Well, that would be Peter Galbraith's contention. But actually, I would say that no. This has been shown by Eugene. Definitely, brokers' loans by New York banks actually fell in the late 1920s. So New York banks cannot be, held responsible for this increase in brokers' loans. So let's have a look then. So where did the credit come from if it didn't come from banks, right? And so if we look at this graph here, this is data from Banking and Monetary Statistics. So we see that indeed in gray here you have loans by banks, by New York banks, brokers' loans made by New York banks, and then you have brokers' loans made by out-of-town banks. And then you have in black here loans made by others. Okay, so it seems that a lot of the loans were coming from others. But who were these others? Well, they were foreigners, they were investment trusts, but primarily they were actually corporations. 56% of the loans came from corporations, which might be a bit surprising, okay? But perhaps not that surprising when you think about it. And the corporations were, whilst they were lending on these brokers' loans, they were sort of retreating from the commercial paper market, right? So they were going into this market, but they were retreating from the commercial paper market. But Ivan Wright has shown that actually, whilst corporations were retreating from the commercial paper market, bank loans actually increased. Bank loans to companies actually increased. So clearly, the Fed was struggling to control credit at the time. Okay. Actually, Fed policy, as I said, was tight in 1928-29. The Fed followed the real bills doctrine. Which basically meant that they fought speculation. They didn't like the idea of speculation at all. And the discount rate had increased from 3.5% to 5% in mid-1928. Brokers' loans rates had increased to 10 to 15%, okay? And even higher if you look at daily rates. And margin requirements, which had been perhaps a bit low before, increased in 1929 to 45 to 50%, okay? So policy was tight, and However, the volume of brokers' loans, as you saw, was what it was. And it kept increasing. And in fact, investors were attracted to the high interest rates. So this has been shown in particular by Smiley and Keene and Ivan Wright and Kendall Berger. And I think there's a quote by Peter Galbraith also saying that, people all over the world, in Hong Kong and Sydney and London, they're all saying that 12% was 12%. That's an attractive rate. So perhaps that is why corporations started to lend massively into this market, although there may be other reasons, of course. So clearly the Fed had no complete control over credit. At least we can say that, right? So actually the Fed did try alternative policies at the time. Adolf Miller, who was a member of the Federal Reserve Board, said that we should try and apply direct pressure, on some banks. But that was at the time when they thought that most of the lending was coming from New York banks. And so they said that, the Federal Bank of New York should apply moral suasion and sort of basically deny access to member banks to the discount window for member banks making brokers' loans for their own account. But of course, it didn't really work. I mean, it worked in the sense that New York banks indeed stopped lending, or almost, at least didn't increase their lending on brokers' loans. But it didn't really work in the sense that it didn't stop the brokers' loans from other sources, especially from corporations, right? So in some sense, the interest rate and even direct pressure didn't get in all the cracks, And so, it knew about direct pressure because it had applied it in 1921 already. So this is shown by a recent paper by Reader. But they didn't really want to apply other forms of direct pressure for various reasons, potentially because in 1921, the effects had been so severe, right? There was a severe contraction in 1921 and that many had blamed on Federal Reserve action, which they thought had been too strong, However, it doesn't mean that other macroprudential tools could have potentially been more effective. So clearly there is no one-size-fits-all macroprudential tool, This is sort of one thing that this paper is showing, but perhaps higher initial margin requirements might have been useful, especially in 1927, 1928, rather than just 1929. Okay, so to conclude, credit grew in concert with money in phase one, but credit grew faster than money in phase two. This made financial institutions vulnerable to any shock, I would argue. And the shocks may have been endogenous to credit. This still needs to be shown for real estate and can sort of be shown for the stock market, although more research needs to be done in this field as well. The monetary authorities were clearly struggling to control credit. And I would say that one of the lessons of the Great Depression might be that additional macroprudential policies might have been more effective.
So I'm going to give a kind of spirited, I think a commentator should, spirited, contentious review of her paper. But I'm never really having fun unless I have some pictures. And you should really understand that all these booms have a lot of color to them. And certainly the Florida land boom was one of them in the 1920s. It's a real estate boom. And you have all the great characters. You have William Jennings Bryan, fresh from having left Woodrow Wilson's cabinet because he's a pacifist and doesn't want to enter World War I, and just before the Scopes trial, promoting real estate in Florida, one of the great American orators. And of course, Charles Ponzi, after promising returns of 100% in 60 days in his first scheme, when he escapes from Massachusetts, he heads down to Florida and offers 200% in 60 days. And lastly, Groucho Marx, who loses a bundle on Florida, but manages to turn that around to the musical and then the film Coconuts. And as he said in line, he's talking about real estate you can obtain in Florida. You can get stucco. Oh, you can get stucco. Okay, so Natacha's paper in brief. There are two underlying questions. First, did a credit boom cause the Great Depression? And secondly, what policy instruments could have prevented the credit boom? And the evidence for number one is that money and credit grew in parallel up to 1928, and then credit, to use her word, decouples from money because there's tight monetary policy. And then the credit boom is reflected in the asset price inflations, particularly in real estate and the stock market. And once economic actors realized some of the assets were overvalued, they started a process of intense deleveraging, which spurred deflation. What I miss a bit here is how the banking panics actually fit more tightly into this narrative. And for the second one, she says that macro and microprudential tools may be needed to keep credit under control. Now, part of my comments reflect some of the literature on credit booms, which I think probably focuses a little bit too much on quantities and not on prices or interest rates. And in a sense, if one looks at a graph of the growth of loans or debt, one might ask the question, is this a credit boom, or is it the growth of appropriately priced risky assets? Now, evidence for her paper is, was there a bubble in the stock market? What drove the bubble? Well, it appears, in a sense, it's the broker's loans driving the market. So it is thus a supply shock. But there are higher interest rates on call loans and other money. So what's driving this credit boom? What is the driving force? What are the incentives behind this? And what's you have to say, if you have one hypothesis, what's the alternative? Well, the alternative would be a demand shock. And I think you just can't, it isn't really rejected because it's not particularly considered. Well, let's skip on to the next slide. I have a short time here. So how do we interpret the market for brokers' loans if this is the driving factor behind the asset boom? You have to understand the market for brokers' loans is something very special in the period. It is the most liquid, short-term money market of the time. It's kind of the equivalent of Fed funds market because it ties together the banking sector and the securities market. This permits us to understand really what's going on. First of all, the market for brokers' loans. This is an unregulated market. It's fairly well documented. It's where banks and non-banks make loans to brokers who pledge collateral in excess of the value of the loan and promise to pay interest. There are two types of loans. There are call loans, which are renewable, one-day loans renewable, and there are time loans, which have various maturities up to 3 months. And the loans are then these are used to fund brokers' inventories and to make loans to their customers. Because after the broker's loan market, there's the margin loans. These are unregulated and undocumented. We have very little idea of what's going on there. But brokers gave customers loans, and they pledged collateral and promised to pay interest. And then they purchased securities on the New York Stock Exchange, the curb market, and the OTC. Now, one point here, because this is some time ago, banks and brokers were free to set margin as they desired. And they they adjusted the margin according to the risk of the assets. Now, she very kindly put up one picture from my paper. I'll put up the second one. So here's brokers' loans and the behavior of the stock market, and here are the interest rates. And what you'll notice is that all the short-term interest rates are glued together. The markets are very fungible, and there's a lot of arbitrage, except for one period. That's the boom. And there's a sharp rise in the premium paid on brokers' loans. The call market's very volatile because it has lots of daily shocks. But the key thing here is look at the time rate. It rises. The premium keeps on rising throughout the year. So what's going on? I would say I tried to bury Galbraith's contention 25 years ago, but I think I didn't use the proper wooden stake to drive through the heart of the argument. So I'll try again. First and foremost, I think this is a demand shock coming from investors who see very high rates of return. And here's the annual rates of return from 1921 to 28. And a bubble forms. Many people who want to get into the market have to borrow. So if you think you can make 20 or 30% a year, it's not too bad if you don't mind paying 4 or 5 and up to 8%. Of course, you know this is not going to persist. And what result of this is there's a huge, unfortunate phrase comes, sucking sound from company pulling money into the broker's loans market from commercial paper market and foreign bonds, where you have fixed interest. Who wants fixed interest at 6 or 7% when you have the potential for 20? So this really thwarts the Fed's efforts just to focus on the broker's loan market. Now, so what you see is all rates rise, a premium of 3% appears and rises to 6%, 600 basis points. So to me, this looks like the brokers are pricing risk. Secondly, margin requirements. They rise from about 25 to 50% So in other words, you have to provide 150% of collateral to buy $150 worth of collateral to buy $100 worth of stock. And what that indicates is how much they think the market's going to drop. So they're really pricing risk into this very clearly. What does this tell us about bankers and brokers' view of the stock market? Well, they're skeptical. They're skeptical of their own customers' demands. And I view this as primarily as a demand shock coming from them. Now, what were brokers expecting? Sometimes we have to find evidence for what's going on. We have to look at collateral markets. And the New York Stock Exchange is a good place to look at the price of seats, how brokers thought, how valued their access to the market. There are a fixed number of seats, 1,100, and by 1929, they're straining to meet the demand on the floor of the market. So one thing which happened is they pushed all the municipal securities off the market. Munis used to be traded on the New York Stock Exchange, but they were profitable enough, they moved off. And Bruno Biot has a wonderful paper on this. Then in February 1929, they decided they had to increase capacity. They gave each member a tradable quarter seat, 25% dividend that could be held or sold. Both happened. And we think that rising stock prices and volume should have driven up seat prices. Turns out there were negative cumulative abnormal returns of about 20% in the month preceding the crash. The brokers are very skeptical about this. And I would say their behavior here is consistent with increasing margin rates, margin loans. They protect themselves against a collapse and are really essentially discouraging borrowing. What are the incentives for brokers? I mean, if we talk about brokers' loans, we have to think about their incentives. Brokerages are basically unlimited liability partnerships with few employees. They invest and compete in reputation, and there are strong incentives to control risk. Trying to think about how I would tell a story of that, you have to say something about if there are employees who have, say, fixed, get fees per sale commissions. And Charles Merrill complained about this when he was building Merrill Lynch in the 1950s, and he based his payments to his brokers on fixed annual salaries, bonuses which came from the total profits of the whole firm. What about banks? I would say in this period, there are no systemic incentives to take risk, rather the opposite. You have to remember there's no FDIC, there's no too big to fail, and there's double liability for bank stock. Directors and officers often own significant shares of banks, and boards meet very frequently, meet once a week, and they usually oversee the making of loans. There are some conflicts of interest, for instance, in universal banks, over the customers of commercial side and the investment side of the bank, but there's no evidence, particularly from Carosa and Rajan, which show that this was systematically exploited. And capital ratios compared to today are relatively high. So there's no real, I see, incentive to push brokers' loans from these guys. So second question, what macro-prudential policy would have helped? Margin requirements. Well, it turns out they're already high and rising at 50%. When they actually institute the margin requirements in 1934, they actually based them on the existing requirements, and then later jacked them up to 100% in World War II and 90% in the 60s. This is really trying to channel credit. Now, the other problem with margin requirements is if they're not set correctly, which is difficult because there's so many securities, by the risk of the assets purchased, then over-margined stocks, there'll be a low demand for them, and for under-margined high-risk stocks, there'll be an increased demand. So I think most of the studies have shown that margin requirements are basically ineffective. And I think the key point here is, are these tools of macro-prudential, or are they a form of financial repression? Not a popular term, but one used quite in the past. And I think economics advises to attack a problem directly, not indirectly. Margin requirements I view as an indirect instrument. And if there are bad margin choices being made by directors, officers, and employees, then I think the policy prescriptions should change the governance and compensation rules for those individuals to provide better incentives to make better choices. What about the real estate boom? Unfortunately, there's limited price data on this. The Case-Shiller index before 1940 is deeply flawed. Talk about that at great length. But there is a housing boom which peaks in 1925. And there's a rise in both new commercial and residential. I'm only going to talk about the residential. And you can see over here, basically, Natacha's argument, you have the rise in commercial construction and residential construction, and these are the loans by various financial institutions. So My interpretation of this, a little different, is that the housing boom and bust of the mid-1920s is very similar to the 1980s and 2000s. One significant difference: there's no banking crisis. Why? And so, what's going on? I think you have to consider all the possible hypotheses. And the one crucial element missing from this story is World War I. And World War I, there's all kinds of tools of financial repression. And this is net real estate construction. And you can see there's a huge drop in World War I, and then a boom afterwards. And so what I've done here is to do a prediction of what would the fundamentals have done. And basically, it would have captured the deficit. In other words, replaced the housing which was never constructed in World War I. And that, in fact, there's a potential bubble, but it's relatively small compared to what appears to be the total peak. Now, there's several possibilities as to what might have driven this so-called credit boom. One is a low interest policy by the Fed. So how do we think about this? Well, I used the Taylor rule, I'd say anachronistically, because there's no federal funds market to apply it to. But if you use the discount rates as a proxy for that, they could have been 2% higher. But this doesn't really have much influence on construction because that's driven by mortgage rates, which are relatively insensitive to short-term money rates. Was there a Greenspan type put? You can argue that the opening of the discount window with the creation of the Fed was such. But this actually adds very little to the expansion of credit. Did lending standards fall? That's a possibility. But interestingly, commercial banks had loan-to-value ratios of 40 to 50%, which are very high. The exception are building and loan societies, which are the forerunners of S&Ls. And they offered second mortgages, about 30% loan-to-value ratio, after the person acquired a 51. You still have a cushion of about 20%. And, well, long discussion about what the mortgage market was like. It's much more heterogeneous than later on. What about riskless securitization? There is a rise in the real estate bond market, a large increase. And new issues vanish after 1928. These all perform relatively poorly. In 1923, 41% of these bonds failed to meet the contractual arrangements. And that rises to about 77% in 1928. But, as you say, why worry? Well, these were not held by leveraged institutions. These were held by private investors. So there's no effect really on the banking side. What about riskier banks? Capital asset ratios trend down a bit. But national banks are constrained by law, holding no more than 25% of their assets in relative to capital in real estate. State banks could hold more. And at the peak, they're about 27% of loans. What's interesting is their bank suspensions over this whole period of the boom are declining. They declined all the way to 1929. And that's so it doesn't seem to have much effect. And foreclosures are relatively low. So the conclusion is that there's no banking crisis, though there's a modest bubble, because real estate loans were not concentrated in financial intermediaries. Some regulations were important for prudent choices, but the damage from the bust was contained. So my conclusion, I put these guys back on, right? Charles Ponzi and Natacha. So in the 1920s, I don't feel that there really was a credit boom in the sense of one that artificially stimulated the economy, leading to an equities or housing bubble. And that they were more like a pure wealth shock when their decline occurred. The leading factor in the stock market boom really, I think, is the irrational exuberance of the investors who pay for an increased risk in their equities when they borrow. There's excessive optimism, and I think that's captured there's a paper by DeLong and Schleifer, captured in the premiums paid on closed-end mutual funds. The leading factor in the housing market boom is primarily the catch-up from World War I, and to a minor degree, the irrational exuberance. I think there's little danger to the financial system in all these. The higher risk assets are not added to the financial systems institutions. Why? Because the general incentives are to place limited risk on all the stakeholders. There are idiosyncratic incentives to take risk among some institutions, but not systemic. There are some conflicts of interest, but they're never exploited to the point where they become generalized. What's the difference today? I'd say that today there are systemic incentives to take risk that did not exist in the 1920s. And correcting these, I think, would be much more effective than imposing a series of regulations to limit choices, but rather to instruct choices.
So thanks very much, Eugene. As I said at the beginning of the talk, this is a highly contentious area. So this is just proof. The proof is in the pudding, right? So obviously there's only a few points that I can comment on, but I'm just going to start by saying that the fact that higher margin requirements might be a form of financial repression, I would say that this is probably right. I mean, this is something that we need to think about, and I thank Eugene for this comment. It's a tricky area, definitely. So how to control credit, how to use these macroprudential tools effectively without repressing finance, the financial system is a very significant issue. The other point about just focusing on the 1929 stock market, Eugene emphasizes that there was a demand shock that was probably the most important fact driving this volume of brokers' loans. I would simply point out the fact that there seems to have been, in addition to the demand shock, a supply shock. I think I would still argue this because investors were attracted to the higher rates of interest. So that means that sometimes looking at rates of interest doesn't always help you, even if they're extremely high, it doesn't necessarily mean that it's a sign of supply being not as high as demand. Because if you read the literature, actually, quite often you'll see that a lot of investors were attracted to these rates. So that also begs the question, how do you interpret these interest rates? And should we be careful about those when we look at credit booms? My third point, about mortgages. So I'll try to be very brief about this. Eugene mentions that commercial banks only made 50% LTV mortgages. This is perfectly right. So this is something that I point out in my papers on Chicago state banks. I would simply point out here that despite this 50% LTV, banks were actually heavily loaded in mortgages. And what this means is that although there might not have been an endogenous shock to asset values and to housing, it definitely made these banks vulnerable to shocks, and to particularly liquidity shocks when they came, right? Because mortgages matured in a very long time. So that means that, again, we shouldn't just look at LTVs, and it shows the difficulty of macroprudential policy, right? It's not just LTVs, it's also liquidity, and it's also just the proportion of long maturing assets that you have on your asset sides that may matter for a bank to be resilient to a liquidity crisis. Did I have a third point? I think that's all. Thank you.
Okay, so in order for us to stay on time, we'll do 5 minutes of questions of this. I apologize that I'm cutting this a little short, but we have to respect Atif Mian's time because he needs to leave to catch a flight. So we'll take 5 minutes of questions. We'll take a 10-minute break, and then we will proceed with the next paper. Okay, so in fact, maybe the best thing to do for the questions is let's collect a few if you have them, and then we can sort of answer them in a set. Okay, Matt.
So I like the paper a lot. I'm very sympathetic to this view that there's sort of a misunderstood credit boom causing the Great Depression. But maybe if I were writing this paper, I mean, you might actually not want to talk so much about margin loans in the stock market. There's a strong argument to be made that the stock market bubble was in some sense a sideshow to the Great Depression in terms of the macroeconomic consequences. And if you look at just magnitudes of what was causing the credit boom, margin loans were relatively small. You want to look at the big ticket items, and Richard sort of taught me this. You want to look at the mortgage lending. There was a huge construction boom, a lot in commercial real estate. All the skyscrapers you could see around here were built in 1929. You want to look at the building and loan societies, the state banks, the mortgage banks. I've learned a lot about this from your paper. Then the other big ticket item is you want to look at the corporate bond market. There was a huge explosion in corporate bond issuance and real estate bond issuance. So I would focus on those big ticket items and push that argument further, because that's what's misunderstood about this period.
Richard Vague, I would just say one of the great things about Natacha's paper is she shows how much lending is occurring outside of the banking system. And I would actually say that's a characteristic of crises. That, in 2008, it's the mortgage banks, not the commercial banks. In the 1980s, it's the savings and loans, not the commercial banks. In 1907, it's the trust banks and not the commercial banks. And I don't think that's a coincidence. I think they're less regulated, and it's easier for folks to make poorly underwritten loans in a less regulated institution.
Any questions?
Yeah, just very quickly. I remember that in, oh, what? Oh, yes, right. And Rob Duggar, I'm a INET board member, retired hedge fund partner. In the years before 2007, the marketing related to mortgage derivatives was extremely important, and the compensation was very high. And the marketing was very extensive. And I'm wondering if there's data on the marketing of brokered loans, because they have a very similar kind of quality. 15% interest rates. As an investor, I would like to get into that market, so I am interested in, and then I'm going to invest a lot of money in the marketing of those to retail, potential retail investors. So if there is any data, and I have a feeling there's a strong similarity between the run-up in compensation for mortgage derivatives and brokered loans from the two periods.
Collect one more question.
Yeah, Morris Scholerick. I found this fascinating. I think like also the sort of the comparison between the Great Depression and the Great Recession. Like, I mean, we have N=2 now. We have 2 observations of these really big crises, and we all want to know what are the commonalities. But sort of in a way, this question to both of you, your presentation raised an issue for various people here in the room. Like Matt presented evidence that the stock market doesn't see it coming, or at least has a paper. And you said, well, the stock market actually might have priced it in. We've gotten used to thinking about these credit booms as sort of, or these pre-crisis macro constellations as times when quantities are rising at the same time as the prices are falling, sort of credit supply shocks, if you will. You said that wasn't the case either. So just like wanted to tease that out a little bit. Like in a way, there's a big question mark now in the room. Like what is the comparison then?
Please.
Oh, I thought there might be other questions.
Is there one more question? We can collect another if you like. Yeah, please. You can respond to these two.
Okay. Can you clarify exactly what you want me to tease out, please? Sorry. I just wasn't 100% clear.
Oh, you mean me?
Yeah.
Sorry, just commenting on is this now, does this fit our narrative of and you might have different opinions, the two of you. Does this fit the narrative of the period leading up to crises? And there's no doubt, like, this was a big crisis in the end, right? Typically, the constellation is rising quantities, rising credit, as well as a depressed price of credit, or like in sort of a credit supply shock situation. Does it fit that description in the end, or doesn't it? And then the other thing was like maybe more a little bit for Eugene, like, okay, do we really how do we think about the stock market really having it?
I'm still a little unsure. Yeah, go ahead.
So to try and, you're right, we have 2 points, and they're very important and very instructive to compare the 20s with the 2000s. And what I would say is that in the early period, there are very few systematic incentives to take risks. They seem to be well controlled. There is in other words, all the stakeholders in the financial system seem to have, in general, the right sort of incentives. The brokers' loans are not like those loans. They're traded on the exchange. It's a very competitive, very transparent market, and there's very small margins to be made. Mm-hmm. There's not these sort of huge possibilities for incentives, for churning and so forth that you see. So I think that what my interpretation is that you can have bubbles rising, you can have crises, you can have the dot-com crisis, and it can collapse, and there's no really longer-term impact. There's a wealth shock which occurs, but that's about it. And the argument, I think, go back to Bill, Friedman and Schwartz are quite right about this. There's a wealth shock from the stock market crash. But if the Fed had been installed in a normal policy, there wouldn't have necessarily have been the downturn that you saw. But if you look at all the incentives within the institutions, they've changed hugely. In this period, there's double liability for bank stock. There's no deposit insurance. There's directors have much more liability according to the law. All these things hold checks, and banks do not absorb risk as much. For instance, in the mortgages, they always only take mortgages they think are designed to limit their risk. So maturities aren't very long; they're about 3 years on average.
But they have to be rolled over.
They have to be rolled over, but the
And
risk
it's
falls.
it's 5 years, and they have to be rolled over.
They're
and over
5-year
again.
mortgages, but the average maturity is about 3.
No, it's 5 years. In Chicago, it was 5 years.
So we differ. Good. We should differ on some things.